Everybody, welcome. Welcome. We are live on Facebook, LinkedIn, YouTube, X, Instagram. We are top of the hour. So maybe we should just get at it. What do you say? Thank you, Ion, for that. Let's go. Welcome, everybody. This is the Sinclair Range Week in Review live stream here on December 12th as we are waiting for people to join us. There was an interesting story 2 weeks ago in the news because this is 2 weeks in review, not just 1 week in review. I missed last Friday again while traveling. And so there was this interesting story about Yield Street, which is a fund in New York, relevant to some of our discussions today, relevant to some of our discussion 2 weeks ago. Sound is good on Facebook. Thank you for that, Ashley. It took me many tens of minutes to log into Facebook for this show today, so I'm glad that is working. We talked about a couple shows ago, Grant Cardone and his real estate fund. And this Yield Street story is relevant to that. We talked about why private credit is a better investment product for those looking for passive income than real estate is. So this story in the Wall Street Journal on Yield Street, it was a fund that launched in 2015 in New York as an online platform to democratize. You remember I've used that word before. That means give you and me, retail investors, access to what some of the big companies, the Blackstones of the world, would be able, the Goldman Sachs, would be able to have access to. And so democratize alternative investments. That's the asset class that we talk about as private credit, but also real estate. They were doing real estate, art, legal finance, and they were targeting accredited investors, much like how Cardone started with $10,000 as a minimum investment. They quickly gained traction because you can do that in this environment when everybody's making money. In 2020, they launched the Yield Street Alternative Income Fund, which was intended to be diversified exposure. 21, they launched a art equity platform. Already things are getting weird. 22, Graycroft, which was a startup for partnership investments. I don't know. Oh, it was a partnership for investments in startups. So a VC type thing, and it was backed by $400 million in credit from Monroe Capital. In 23, they launched a real estate platform called Cadre, C-A-D-R-E, however you may pronounce that. So then it says in the Wall Street Journal that challenges emerged. Do you think so? They had economic shifts, the interest rate hikes from the Federal Reserve, tariffs, of course, floating rate debt on their deals with real estate, and things started to go bad. In total, investors took a $208 million loss. They had an $89 million on key defaults for marine loans. So they were lending. I assume that means it could mean on boats, could it? Maybe it could. I'm going to guess it's more marinas. But marine loans wiped out $89 million in value, $41 million in recent real estate projects in Houston and Nashville. And it just went on and on and on. They reviewed 30 real estate deals and 370 million, totaling 370 million, and they had a 30% default rate. Okay, the industry average would be 2% to 8%, and they have so much backlash that the point of the story is they have a new name, Willow Wealth, but that's not interesting. The interesting part is the arc of they're going to democratize access to private credit, and they sell a bunch of product to you and me for our retirement accounts. And then what happens? They lose it all, and they have such a bad reputation and allegations of fraud and other things that they have to, checking Instagram there, that they have to actually rebrand themselves Willow Wealth. So last week we talked about private credit, passive investments as an alternative to real estate. Forget that there is no such thing as a passive investment, but the thing about private debt is you're going to generate, as opposed to a real estate fund like a Grant Cardone, which we will talk about more later in this particular week in review, is that the private debt works really, really well in low interest rates, and then it works even better in high interest rates. That's not true with real estate. Not true with real estate, as Yield Street proves, and also you don't have to property manage the private debt portfolio. So more on that later. That was just an interesting story I thought tied into everybody, all of this, as we give everybody a chance to join us here at the Week in Review of Sinclair Range. Welcome, everybody. It's December 12th, 2025. We are doing 2 weeks in review at Sinclair Range. My name is Scott Sinclair. I am the owner and founder and president of Sinclair Range. And the mission here on this particular show is to give you insight into what's going on at Sinclair Range, your window into real world deals, decisions, day-to-day business adventures at Sinclair Range as we rebuild this business and grow our equity value. We're taking you along for the ride. So let's do that. We try to break it into this content into general categories: lessons learned of the week, interesting file or deal of the week, struggles of the week, my observations or musings if we get around to that. Let's get at it. Thank you for joining us. I was in a meeting 2 weeks ago now. I was in a meeting with a client reviewing their investment returns with one of their brokers. They have two different brokers, two different shops. Some capital here, some capital there. Doesn't matter who or where. None of that matters for the point that I'm going to try to make. And that one portfolio that we're reviewing is averaging 5% over the last year in an equities portfolio, and over 3 years averaging 12% annual return. Big difference. So 5% annual return 1 year, 12% annual return 3 years. The other portfolio with the different broker is averaging about the same over the same periods of time. And that's all net of fees, of course. And so my question to you, for you to think about, is which broker, which wealth advisor is doing better? Caution, this is a trick question. It is not simply tied to returns. The returns have to be considered contextually. In other words, what was the mandate of the wealth manager when you put the money into, when you go to your stockbroker and you say, hey, here's a little bit of money, I want you to manage this. They're going to ask you a bunch of questions and what your goals are. And the returns have to be managed, have to be viewed in comparison to the goals and to a benchmark. A benchmark being an independent, here's how the market's doing, something that's relative to my goals, where I'm trying to go with this portfolio. And so as an active manager or someone trading stocks or funds or whatever, am I going to meet that benchmark? Okay. And so you need to have goals and you need to have a benchmark. Otherwise, you don't have a measuring stick. You don't know how you're doing. So one of these funds, one of these portfolios, remember, two portfolios relatively the same returns. One of them had a growth mandate in equities, and the other one had a conservative, this is the pension. If all else goes wrong, I have this conservative income-based approach. So two entirely different approaches, but they end up in more or less the same place. You see what I'm saying? So you can't just look at raw returns. You have to have a goal for your portfolio, and you have to have a measuring stick, a benchmark. What is the benchmark? Well, for the growth portfolio, it seemed to me that there was sufficient funds in this portfolio and sufficient number of investments. At the end of the day, what they were really doing was buying almost every equity that you can think of in the U.S. And in Canada, for that matter, but largely in the U.S. And so a good comparison, and every real stock, something on the S&P 500. So a good benchmark, a measuring stick for that would be a Vanguard fund. I picked out the VFV, Victor Frank Victor fund, and we had to calculate, because it's not immediately obvious what the returns are when you look at these sort of index funds. But the returns on a 1 year basis were 20.63% compared to 5% for our portfolio. 3 years, 24.85% compared to 12% for our portfolio. So there's your benchmark. You've picked a comparison. You have a measuring stick. How are we doing compared to that? Oh, look at that. Our portfolio sucks. Now, the counter to that argument, and the broker would tell you this, and I think the broker is absolutely correct on this, is that no, Scott, that S&P 500 or the index fund, which, if you look at wealth management advice, if you look at the new book by Jordan Belfort, The Wolf of Wall Street, he's going to say, buy these index funds. That's what he's going to say. It's low cost. You get diversity. And what this broker would say in return is, yeah, but the S&P 500 is really, really weighted towards 5 or 6 key stocks, all of which are influenced by artificial intelligence and that are definitely in a bubble right now and will burst. That's what's going to happen. That would be the counter argument to this. And those stocks, think Meta, think Apple, think Google. Okay, Tesla would have been in there before. So think of those stocks, and you have over concentration in those companies if you're buying an S&P 500. That's all true. The flaw with that analysis is that when the bubble bursts, if you buy into the narrative that AI is a bubble, which it is, and that bubble then bursts, it's not just going to take down Google, it's going to wipe out everybody. It's going to wipe out companies that have nothing to do with AI because it's going to be mass panic in the markets. In 2020, when the tech bubble burst, what happened? I owned companies at the time that were that were managing people's portfolios. We had retirement savings account, and a lot of those that were tech centric went down 60% or more and never came back. The index came back, but the companies they were invested in never came back. Your RSP, if you were Canadian, all of a sudden you woke up, you had 100,000 one morning, and then you woke up and you were down to 30,000. And your whole retirement plans changed because you were exposed to a bubble. But not just the stocks that were creating the bubble. It wasn't just the OpenAIs of the world back then, which of course is not a public deal at the moment. Okay, and so in fact, you might argue that the Googles of the world, they went down, but those are the ones that returned. It was all these little stocks that got wiped out, and that caused the real pain. So what's the point? What's the point of all this? When you're investing, I am not your financial advisor, but my advice, and I'm not trying to sell you any product, but my advice is if you're planning your investment, if you're planning your retirement, you need a goal. You need a plan for your portfolio that fits into your retirement, fits into your business needs, fits into your lifestyle. You need the plan, and also you need the measuring stick, which is a benchmark. And in the long term, when you think about this plan and this benchmark, in the long term, risk and reward are totally correlated. The more risk you take, the more reward you can get. You take less risk, you're going to get less reward. That's the way it works. You could get wiped out by taking more risk, but you're not going to get better returns in the long term. You can have arbitrage in the short term, okay? But you're not going to get the returns without risking losses. That's just the way it is. So always think about that. There is one exception to this in my mind, which is knowledge or information arbitrage. Okay, so that is a way to get outsized returns without a lot more risk. So think, for example, the venture capital world, the tech billionaires from Silicon Valley. Listen to the All In Pod guys, and you will see what I mean about outsized returns. These guys are filthy rich. They do fantastic because they know, first of all, they're really smart, really smart, but also they know way more than you and me about artificial intelligence, for example. They're in the core of it. They're building the companies. They have better information than we have. And I'm not talking about illegal insider trading information like Congress. I'm talking about legit. They're smarter. They have direct access. It's all they do all day. And so they have better information. There is an arbitrage there because they worked at Google. They worked at Facebook. They're in the center of it. They have an advantage over you and me. So if you're in that position, of course, you can take less risk and get outsized returns. Another example would be in the private credit space. Sinclair Range has an advantage in that space. We know the market, we know the laws, we know how to turn around businesses. And so on the private credit side, I think we have a similar, just an outstanding arbitrage advantage in information. So let's move on to another story. What I'm going to tell you right now is all public information, but I'm still not going to drop any names on that. And as a context, do you remember on this show right here, maybe 6 weeks ago, I announced the formation of Sapphire Global Finance. Sapphire Global Finance, a Canadian investment company that is doing secured high-yield private credit, as I'm always talking about these days on this show, to companies. We're based out of Calgary. And I told you on this show, to repeat some content from, I think, from 2 weeks ago, that we closed our first deal after just forming, and we did a debtor in possession loan into a company in Canada in the cannabis space. By the way, did you see cannabis stocks today exploding? That's kind of exciting. Anyways, a debtor in possession loan for a company in CCAA, Companies Creditors Arrangement Act, which is the Canadian equivalent of a Chapter 11 proceeding in the US. If you want to seek bankruptcy protection as a company, I don't care if that's a Chapter 11 in the US, CCAA in Canada, NOI, Notice of Intent to File, notice of intent to make a proposal. Sorry, that's what that is. Sorry, I should have had this phone off. Just bear with me. I'll ignore all that stuff. Notice of intent to file a proposal in Canada. I don't care what it is. It costs significant money for professionals to do a restructuring. Well, DIP loans help, debtor in possession loans help fund those professional fees, and they keep the company rolling during that process, okay? And so that's what debtor in possession loans are for. With your company and you need protection, you go to court and say, hey, judge, what I'd like you to do is just put a pause on everything and allow me to operate, get our act together, make a proposal to our creditors, and come out the other side with a healthier balance sheet and a healthier business. By the way, I would like you to approve this financing, this debtor in possession financing, to help pay everybody. It's for the good of society as a whole that we survive and continue to create jobs or maintain jobs that we already have. That's the point of debtor in possession. So because a borrower just can't afford out of normal course proceeds to pay for this restructuring process. It's just too expensive. So when you are a DIP lender, what happens is you get approval from the judge, and the judge says, okay, you could do this debtor in possession loan for this borrower, and we're just going to put you ahead of everybody. So on this particular cannabis deal, Sapphire is a first lender that get put ahead of the first mortgage on a piece of real estate, obviously ahead of the second and third as well. They get ahead of the secured creditors on equipment and other intangible assets. So it's a pretty good deal. The judge just gives you this super priority charge. So Sapphire signed a loan agreement. I'm not going to give you the amounts. I think I may have disclosed that in prior shows. I don't recall. But the percentage returns, they end up to be in the mid double digits. I mean, they are huge, which is fantastic from a lender's perspective, but really, really, really expensive from the borrower's perspective. But why? Why does that make sense from a borrower's perspective to pay this amount of money? Well, first of all, no one else, they went to 150 possible lenders to do this deal. Nobody else wanted to do it because it's complicated. They didn't understand how to get into this thing as a lender to protect themselves. And so what does that do? It drives up the cost of capital. As a lender or an advisor to a lender, so Sinclair Range is the exclusive advisor to Sapphire Global Finance. As I said, we have this information arbitrage, which allows us to do better than other prospective lenders and investors may be able to do. And from the borrower's perspective, yeah, it's a huge percentage rate of return, but the amount of money in the grand scheme of things is not that much. It's really not that much. So with a little bit of money, you're creating massive amounts of value for all the stakeholders, for the employees, for the community. right? You're creating this value. And yes, on a percentage basis, the lender, the dip lender, Sapphire in this case, is getting a terrific return on his money, but it's for the good of everybody and it's not damaging the overall plan. It all fits really well. And from Sinclair Range perspective, that's fantastic. And also our mandate as a company, I don't know if I've discussed this on the weekend review at Sinclair Range before, but our mandate is defined as saving and creating local jobs, right? If you're working with a troubled business and you fail, they're going to shut down and all the jobs are going to be gone. If you're working with a high growth company and they fail, they won't be hiring all of those jobs that you wish they were hiring into that local community, not outsourcing it off to foreign manufacturers, but in that local community. That's a great measuring stick for the success of our business. So that is what we try to focus on. So with all of that said, the point here is that if you have this information arbitrage, you can get outsized returns. And this deal that Sapphire did is an example of that. It's a win-win for all parties involved, including the process itself. It's full of integrity and it helps the community. And we're really proud to have been associated with that. It's very exciting for us. And the lesson I think that we can all learn that is probably very interesting is as I said at the beginning, that risk and return are always related over the long term. And the one way to get out of that problem is to, well, not a problem, but one way to escape that reality is to have an unfair advantage, to have an information knowledge arbitrage in a particular area. And on the investment side, on the passive income side, I think that absolutely, absolutely relates to Sinclair Range and these distressed private credit debts. So anyways, I wanted to bring that to you. Now, how does that relate to last week and the Grant Cardone conversation we have? And why, Scott, are you talking about that again? First of all, let me recap what we talked about with Cardone last time. I was explaining to you that what Cardone does is sort of brilliant, is he creates this funnel, a sales funnel to get access to your money for him to invest. That's what he's doing. It's a crowdsourced model rather than going to, big pension funds or whatever to get a bunch of capital to manage and have the oversight and problems, regulation that goes along with that. He's going to get your money and to get 1 million of you to give him a little bit of money. And the way he's creating that funnel is through his social media content, books, courses, conferences, enticing you with pictures of his plane and his condo in Miami and his beautiful family and all that sort of stuff. And you start paying fees for business courses, for books, to attend conferences, to have coaching. And all of that is a really lucrative fee-generating environment, ecosystem. So it generates a lot of cash flow for him, but it also, you all turn into investors is the idea. So you start with so many at the top, so many of you are going to flow at the bottom. Not everybody, of course, but you're going to start investing into his funds. So I explained that last time. I'm going to explain that in general, those funds are used to buy real estate. If you listen to his content, what he says is, yeah, you need to do this. You need to be in real estate. It needs to be passive income. You should be investing. Don't spend money on this, spend money on investing. And by the way, you can't just buy one unit. You need to start with a minimum of 32 units. And by the way, you can't property manage it. Therefore, you shouldn't do this at all. You should just invest with me and let me do it for you. That's basically the pitch, right? And then when we start talking about that, we start thinking, well, he's raised $1.8 billion over the last decade from retail investors, and his average return is about 8%. Okay, so that's all context. That's all background that we talked about on this before. And so he's averaging about 8%. But your S&P index, remember, you need a benchmark, you need a measuring stick. Well, it did over the same decade 14.9% on average. So he's doing close to half, like just over half of what the S&P is doing. Now, why are we covering this again? Because it turned into a huge TikTok debate. So, we have a good audience for this show. I always have to flip my screen to look at Instagram. We have a good audience for this show on the live stream, on the various platforms, Facebook, LinkedIn, YouTube, X, Instagram. When you add it all up on the audio side of this podcast, doing really well as well. So when you add it all up, you're getting a decent reviews and audience for this show. But it pales in comparison to the shorts that are created out of this content and that are pumped through the exact same channel. So we do shorts on Facebook, we do shorts on YouTube. I don't know if we do them on X. I don't think we do. Definitely on Instagram and TikTok, where we do not broadcast live, but on TikTok. And some of the TikTok ones get really a crazy number of viewership compared to everything. And the algorithm seems to drive the content that has debate and comments. And wow, did the Cardone thing drive debates? And it was generally along the following lines: Scott, you're a hater. I'm not a hater. That's just wrong. I specifically said he is a tremendous success. I don't know enough about him to point fingers or not point fingers, and I don't care. My opening position is I try to applaud success. And so not a hater at all. So let's just dispense with that. It's not for me to judge. I'm not an investor. I don't know what's going on. I don't really care one way or the other. I'm not trying to judge. I'm trying to use him as an example. Okay. The second thing is, yeah, it's 8%. You're right. It's an 8% average return, Scott, but that's just the yield. You forgot, Scott. You forgot about appreciation. There's yield and there's appreciation. Did I, though? Do I look like I would forget about appreciation? Do I strike you as that type of person? Look at, what does that mean for those that don't know? When you invest in a piece of real estate, we'll just keep it simple with that, you get your monthly income. Flows through the fund, flows out to the investors of the fund. That's your yield. It's the cash flow coming at you. And let's say you're doing that for 3 years or 5 years, some amount of time. You get this cash flow. And at the end of it, you're going to refinance the property or sell the property and take your principal back. But in the meantime, the property went up in value. Presumably, maybe you added some value to it. You did some renovations. You made it, you did an extension. You did whatever. You threw out the bad tenants, brought in new tenants. You've created some value. That's why you did the deal to begin with. And as a result of that, the value of the property went up. So when you sell it, there's some appreciation, which investors also participate in. Do you think I missed that? Really? Is that what you think? The 8% includes appreciation. It includes yield and it includes appreciation. Okay. And that is all pre-tax, by the way. That is all pre-tax. Now, why is it 8% when you would think, my gosh, on paper, that should be way, way higher? That should be 15%. It should be 20%. Well, you need to think about why it's only 8% on average, because if you start front running acquisitions, what does that mean? Front running. It means, okay, I'm going to have a fund, and it's going to be a real estate investment fund, and you're going to make a bunch of money with me. And now I see a building over here. Instead of having the fund go buy that building, I buy that building personally. And then I sell that building to you, the fund, and I have a markup, 10%, 15%, some number on the way in, because it was my deal. Why should I give that to you for free? So instead of having the fund do that, I do it myself, and then I flip it to you. That's called front running acquisitions. There's lots of chatter on the internet that the Cardone Group does exactly that. Some people say that that's unethical. Some people say it's fraudulent. I would suggest to you that if it's disclosed, there's not much that you can do about it, but it definitely takes away margin from the deal. It lessens the returns to the investors. So if you front run, you have less return to the investors. If you charge a significant administration fee to the fund as a fund manager, it lessens the return to the investors. If you charge a significant property management and improvement fees to the deal itself, to related party companies, it lessens the return to the investors, and on and on and on. Everything drives cash to the organization the Cardone organization. It's not an allegation. That's just a reality. Everything drives cash, and there's only one pool of cash. If more of it goes to Cardone, less of it goes to the investors. They're doing 8% on average. And then the third allegation from TikTok is, Scott, you're totally forgetting about the tax benefits of real estate. Again, am I forgetting about that? When you're looking at an 8% return, including appreciation, when you're looking at an 8% return, that is a pre-tax number. It is true that a real estate fund can in some instances give you some significant tax benefits. Should I consider that in this analysis? No, I should not consider that. The proper way to analyze financial returns is pre-tax. After tax is the only thing that matters to you and to me as an investor. I have to pay tax. It's the only thing that matters. But as a fund, you should talk about pre-tax returns. Why is that? It's because you and I as investors are not the same. If I get a bunch of tax losses out of an investment in a real estate fund, perhaps I can use all those tax losses and they're really, really valuable to me. And therefore, it enhances my return after tax. Perhaps you're not in the same position and you cannot use those tax losses. They're useless to you. They don't add any value. And so now our after-tax returns on the exact same investment are different just because our tax situation is different. When you analyze a financial product, you do it pre-tax. When you consider a financial product as an investor, you think about it after tax. So TikTok, you're wrong. Get off my back. Thank you. Actually, thank you very much for watching those videos and participating and engaging in the conversation. I love that I replied to many of you. Thanks for doing that. But I did want to give that response so everybody can think about it. By the way, in private credit, there is a lot of tax benefits that can be structured into that as well. The point of the last show, by the way, with the Cardone discussion was that what if you can get access to private credit as a product like that Sapphire deal on the dip loan on the cannabis company? What if you could generate a return that's roughly 700% higher than the 8% on average that Cardone returns and be just as secure, risk reward, playing off this arbitrage of knowledge and information? Shouldn't you be doing that? There's about $250 billion of new money in 2025 in the US that has moved into private credit. Smart money. It's done that for a reason. All right, let's move on. Checking Instagram for comments here. Nothing there on that side. Thank you for commenting and participating on the other platforms. Let's move on here. I talked about, again, in a prior show, the concept of sell-through versus sell-in. Do you remember that? Sell-through versus sell-in. So just shortly to recap, sell-in means I created a product and I sell it to, let's say, Walmart. And I think to myself, cool, Walmart just bought $300,000 worth of my stuff to put on their shelf. It took me a year and a half to go through that process and get listed with Walmart. And they did a stocking order, right? So they have some inventory. And now they put this on their shelves and I got a PO and I get paid for a $300,000 order. I'm doing awesome. That's sell in. What is sell through? Sell through is when a customer walks into Walmart and buys a unit of of your product. That is sell through. And if there's no sell through, Walmart will never order from you again. Got it? Sell in. Walmart agrees to stock my stuff. Sell through. Walmart needs some more of my stuff because they sold it to an end consumer. You, as the manufacturer, as the provider of that product, it is your job to sell the sell-through, right? To create demand from consumers to go into Walmart and buy your widget, whatever that may be. That's not Walmart's job. Walmart's job is to merchandise it and to distribute it. But you need to create that demand or this whole thing is going to fail. So that's sell in versus sell through. Well, in a similar discussion I had with a client this week, We were discussing the build it and they will come mentality of manufacturers. Hey, I have the best product. I have the new mousetrap. It's better than everything else. This is going to work. It's like in the 90s when we were doing tech deals, and I founded and owned Merchant Capital back then, and we were doing a huge number of tech deals. And in the Ottawa community, there was software developers all over the place. 3 guys, usually guys, in their garage, and they built something, and it is the best application piece of software in this, like AI today, in the software tech industry. Best piece of software. And then what happens? Nobody buys it. Literally nobody. Or maybe they sell $1 million worth of stuff and then they just tap out right there. Why? Because they don't have any distribution. Microsoft, on the other hand, does what? They make a piece of crap software and then they forced you to buy it in those days and they win. They had all the distribution. The product didn't much matter. They had the distribution. You get wiped out because you have no distribution. The value of your world-beating product is nothing because you have no distribution. And the company with all the distribution, with the whole market tied up, wins because they have that, even though their product is crap. Do you remember Lotus 1, 2, 3? Do you remember that spreadsheet? Nah, you probably don't, unless you're old. Do you remember WordPerfect? Microsoft Word was a piece of crap. WordPerfect, all the lawyers worked on WordPerfect. Nobody worked on Microsoft Word. Do you remember WordPerfect? Nope, you do not. They got wiped out by distribution. In the financial business, we talk about manufacturing product. Weird word for in the financial industry, right? But manufacturing, wholesaling, distributing, and sales. Manufacturing, wholesaling, distributing, and sales. So what does that mean? Well, manufacturing is someone creates an investment product. You create manufacture a investment fund to buy, improve, and flip real estate and make it available to accredited or retail investors like you. That is manufacturing in the financial world, a product. Okay, so that would be that. Now, what does the wholesaler do? Well, you need to sell this unit, this fund somewhere. In other words, I need to get investors. If it was me, I need to have investors buy into the fund. Well, where are those investors? They're with the wealth management companies, with the brokers. So I need to hire a wholesaler, and the wholesaler is someone who goes, and who's selling this fund to the broker dealers, right? Who's talking to compliance, who's talking to the key salespeople there, who's generating interest, taking people out, whining and dining them, and telling them why this is the best product ever. Okay, so that's manufacturing, wholesaler, distributor. The distributor is the broker dealer themselves. They've got a bunch of salespeople, being the wealth manager or the broker, working for them, but they also have compliance, they have underwriting, they've got risk people, so they've got all sorts of things. And mostly what has to happen is the distributor has to approve the deal, the manufactured product, so that the salespeople at the end of the chain here is allowed to sell it. So before your broker can sell you a unit in this hypothetical fund that we just created, it has to be manufactured, it has to be sold by a wholesaler to a distribution company, and the distribution company has to approve it, and then the salespeople can sit down with you once a quarter to review your portfolio and say, hey, you should buy some of that fund. All right, so that's the way that works. Now you can apply that to any industry, that same level of thinking. I pick on financial because it's an industry that I know pretty well and it's current on mind right now. So here's a question for you. Who makes the most money? Who has the power in that relationship? Is it the manufacturer? Is it the distributor? Is it the salesperson? Well, the answer to that lies with whether, as a manufacturer, you are hugely distinct and you add value to the extent of even being a new category. Think Apple, think Tesla, okay? Products that are so different from what existed at the time that they were able to create their own brand, and you could care less back in the day when you were a BlackBerry user how Apple sold their product. Made no difference what their distribution is. Nobody had to sell it to you. You didn't need to see an ad. It was so distinct, you wanted that product. Tesla has no marketing. There's no marketing department. It is such an amazing product. It is so unique. It is so distinct that you just want to go out of your way to find a way to go buy that. It's not hitting you over the head. But every other product, every other situation, which is probably you, definitely me, it comes down to sales and distribution. That's where the power is. Just like Microsoft had the sales and distribution power in the software example. And with that power comes margin. As a manufacturer, if you don't have the power, which you probably don't, you're not going to have the margin in the long term. If you are a sales and distribution powerhouse, you have the power and you will have the margin. Okay, so what does that all mean? Why are we talking about that? You have to understand in your business, we have to understand at Sinclair Range, including with our clients and our portfolio company, where the power lies on that manufacturer, wholesaler, distributor sales chain. Where is the power and where are we on that? And we need to behave accordingly. If you don't have the power and you're a manufacturer, look, I've seen so many products in the last month or so that have come to us, companies that have come to us and say, well, we've created this new product in the health space, for example. I've seen a lot of those lately. And it's the next best thing. Here's what it's going to do for you. Anti-aging, anti-whatever. Terrific. But you're not selling any. You're not selling any because you're trying to fight this distribution channel. You don't know how it works. You don't know how this product's sold, and you're going to fail. Just like the best software company in the products in the 90s failed. That's what's going to happen. You have one of two things. You need to play the game. You need to play the game and understand how your distribution in your industry works, and you need to become part of it. Or you need to sidestep it in time entirely. You could be Grant Cardone. You can go direct to consumer. You can create your own brand and offer and create your own distribution and sales channel. So think about that. We talked about and understood in our prior episode, as I said, sell in, sell through. Similar concept. Where are you on this chain of manufacturer, wholesaler, distributor, sales, and where is the power in your industry? Where are you, and how do you consider how you're going to evolve your business strategy in that framework? Okay. Struggles of the week. So several, we've been working with, where are we on time here, bro? Oh my goodness, are we overdue or what? Should we do this? Do you want to do the struggles of the week? We are so late. Nope, I'm going to keep this short. That's been it. Thank you. We'll do the struggles of the week next week. Thank you for joining me. This has been the Sinclair Range Week in Review. Thank you for all the kind words, the people that reach out, that DM me. Keep it coming. If you want something you want me to cover on the show, let us know. And if you are a company heading into a transition, that could be financial distress, it could be high growth. If you're doing deals, that's what we exist for here at Sinclair Range. So reach out to me, let us know, and we will talk to you next week. And next week might be the last week in review for the year. I think we head into Christmas after that. So I look forward to seeing you then. Cheers.